So let's move on. And then, may I please call on stage Rajesh Gandhi, partner of Deloitte, who would be presenting some amazing lectures on masterclass, role of professional services firm in setting and managing an AIF. Everybody!
Right, so I will not spend time in talking about Deloitte or what we do, etc., but rather spend some time in talking about a bit on structuring, bit on recent updates, both from a regulatory and tax perspective. And thanks to all of you for staying back late in the evening. And I'm also glad, as Aditya mentioned, we have over 500 registrations online. So also thank you to the audience which is listening to this online on YouTube or whatever channel this is. So this is a quick kind of a synopsis on onshore versus offshore structure for investing in an AIF. And as you can see, if a fund, if an AIF has on offshore investors, then depending on the volume of investors, you can either structure it as a master feeder structure, and even within a master feeder, you can have the foreign investors come in directly as FPIs in and invest in Indian securities, or the foreign investors can come into the AIF. Now there are pros and cons of doing that. So one, if you pool everything into the AIF, then foreign investors don't need a FPI registration, and you can pool all your money. The AUM of the AIF becomes much larger. You can have your loss and profit set off because you'll have only one SSE as far as India is concerned. On the other hand, if you invest under the FPI route directly in Indian securities for the foreign investors, then one is you have to take FPI registration, but then there are benefits of having direct access to Indian investment, including the fact that for foreign investors you get a concessional tax rate and a capital gains tax treatment. Now, as far as the AIF itself is concerned, as you know, most people set up the AIF as a trust. But nevertheless, there are certain investors who set up a company or a LLP structure, especially those who do high frequency trading or derivative trading, because then the surcharge on income reduces, thereby reducing their effective tax rate. But the problem with the company or LLP structure is that all your data is available on the ROC website. So unlike a trust structure where the beneficiaries would not be known, etc. So this is just again to give you a synopsis of what are the different documents needed at the time of setup. So one is the trust deed, which or the LLP agreement or the memorandum, depending on how the AIF is structured. You also need a PPM or a private placement memorandum, which is like the prospectus for IPOs. And SEBI has prescribed a standard PPM template 2 years back, which makes our job a little bit easier and also reduces the number of questions which come from SEBI, because now you follow that standard template and try and include all the clauses which are there in the standard PPM. Then there's a contribution agreement between the investor and the fund itself, which is like a shareholder agreement, and the investment management agreement. It is important that all these things, all the 4 agreements are structured properly from a regulatory and tax perspective, keeping the commercials in mind. These are some of the key terms. I think we are all experts, so I'll not spend time on this. In terms of the setup process itself, our experience has been that it takes about 3 weeks for us to initially do the discussions with the new fund in terms of their investment profile, their structure, planning from a tax perspective, their commercial requirements, looking at what the market practices and bringing in the best practices from a commercial point of view. And then once we have the documentation in place and we file with SEBI, it takes roughly about 1.5 to 2 months to get SEBI approval. And after that, it takes about 7 to 10 days for demat account opening, custody account opening, and things like that. So all in all, the process takes between 2 to 3 months at the bare minimum, if I can say. And in terms of the flow, how it works is that we first spend some time in terms of finalizing the structure with the client, considering the various requirements which I mentioned earlier, the entire structure of the client, the holding structure, how many shareholders are there, would the sponsor and the manager be different or the same entity, and then would employees also participate in the returns, what happens to dividend distribution right up to the shareholders and things like that. Then we help in preparing all the documents, the various fund documents which I mentioned earlier. Then the draft application is given to the merchant bankers, and once they vet and review the application, it is sent to SEBI for approval. SEBI takes around 21 days, or is supposed to take around 21 days to review the application and ask questions. Generally, SEBI does have a lot of questions. And then once we submit or prepare our answers, it again goes back through the merchant banker to SEBI, and SEBI grants license. Of late, we have also seen that SEBI has started giving in-principle approval subject to review of PPM in certain cases, which would mean that other than the PPM, most of your other structure is then blessed by SEBI immediately, and only the PPM then requires some more deliberation. This is the rough estimate of the cost. Don't hold me responsible if you get a higher cost from some of our other folks or service providers, but this is a broad estimate of the cost for setting up and ongoing compliances. We are going to leave all these slides with you, so even if I'm going a little bit fast, this will all be there with you for later consumption. Let's talk about some of the key challenges, first from a tax perspective. So, and the challenges are more for a Cat 3 AIF rather than a Cat 2. So, one is that, generally as AIFs are set up as a trust, there are complexities around trust taxation. And you heard during the day that, we have been representing to CBDT and the MOF to provide a pass-through for Cat 3 AIFs, but till the time it comes, we will have to deal with certain complexities. One is that if the trust is set up as a discretionary trust, then there is some risk that tax authorities may say that the trust should be taxed at the MMR or maximum marginal rate. So far, thankfully, we have not seen any notice or scrutiny from the tax authorities in that direction. And the second is that even if they say it's an MMR, should the trust be taxed at the full rate of 30%? Or, for example, if it is long-term gains, can you still take the 10% benefit? The law is not clear, but most trusts and even we advise that MMR means the highest rate applicable to the income. So we take 10% for long-term and 15% for short-term. And then if you have foreign investors, then there is no clarity in terms of credit because the tax is paid at the trust level. It is not a TDS, and whether the investor can claim a credit in his home country depends on the home country laws. US investors generally are able to claim a credit based on the K1 issued by the AIF, but in some countries there's a challenge in terms of claiming credits. The other is on the characterization. Unlike a FPI, which has clarity in terms of capital gains, as I said earlier, for an AIF or a trust, there is no clarity, and so especially those AIFs which follow a long-short strategy, which are HFTs, or which churn their portfolio quite frequently, there's always a challenge around whether the income can be considered as business income and therefore subject to tax at 30% as against the rate of 10 or 15. So that has to be managed in multiple ways. Some funds would have two portfolios, one for their long-only strategy, one for trading, two separate demat accounts, or you could have two schemes. So it depends on the commercials of a particular trust. Carried interest, this is one potential issue. So far, we haven't seen anything being raised, and Aditya and I, we have been deliberating every year how to take it up to CBDT and ask for a clarity on carried interest taxation. The only signal coming from the authorities is the ICICI tribunal ruling, where the tribunal has said that service tax is payable on carried interest. We have been hoping that the income tax authorities don't follow the same treatment. So far, they haven't questioned in a lot of cases. There have been some initial questioning, but no disallowance, I think. But this is something which one has to be careful, especially if the carried interest or the performance fee is going to the same person who receives the management fee. There, I think your argument becomes a little bit weaker. Then in terms of expense reduction, management fees and other expenses, you have a challenge in claiming any benefit for that tax benefit because the income is capital gains against which you can't claim any deductions. And finally, if you have foreign investors in the Cat 3 AIF, you also have the exposure of the indirect share transfer tax or the Vodafone tax, which there's an exemption for Cat 1 or 2 AIF, but not for Cat 3. Let me quickly move to some key regulatory updates for AIFs. One is that in last month in Jan, AIFs have been allowed to participate in credit default swaps. In the case of CAT 1 and 2, this can be done only for hedging purpose. And for CAT 3 AIFs, they can do it for hedging or otherwise for investment subject to the 2:1 leverage limits. Then earlier on 9th of December, SEBI prescribed enhanced due diligence for foreign investment. There was a lot of uncertainty or anxiety in the market to what extent the circular extended, because the way the circular was worded, some people thought it extended to investors coming from non-treaty countries like Cayman, Mauritius and things like that. But our view is that the circular at worst only applies to investors coming from 3 countries, which are Iran, Korea, Northern Korea and Myanmar, because these are the 3 countries which have not progressed in terms of addressing the deficiencies under FATCA or have not committed to a action plan. So investors coming from other countries like Cayman, Bermuda, etc., to our mind, should not be impacted by this circular. The other one is on declaration of timelines for first close. So in November 22, SEBI said that for closed-ended funds, they are required to disclose their first closing within 12 months from the date SEBI has accorded approval to the PPM, and then the final closing should be counted from the date of the first close, or rather the tenure of the fund should be counted from the date of the first close and not the final close. I think this is important for CAT 2 funds in particular, because many of them were trying to drag the tenure of the scheme by taking the final by taking the tenure from the date of the final close, but SEBI has clarified that it should be from the date of the first closing. Saving grace is that there's a grandfathering for existing funds, and this applies only to new funds. And then there is some impact in terms of fees, because if there's a change in the manager or the sponsor, then you have to pay SEBI registration fees similar to what you would pay on a fresh registration. There is one ease in terms of outbound investment. Earlier, the regulations required that for an AIF to make investments abroad, there needs to be an India connection, which has now been clarified to say that there is no need for India connection, and subject to the overall limits and obtaining approval from SEBI, AIFs can make any amount of outbound investment in any company. Lastly, a few months back in June 22, SEBI has clarified every AIF needs to appoint a compliance officer who can be a person other than the CEO of the manager. So you could have 2 managers and one of them could be a compliance officer, or you could have a manager or a compliance officer who is separate. Moving ahead, I also want to invite your attention to a recent discussion paper from SEBI, where SEBI has asked for public comments by 18th of Feb. So we do have time, and if you would like to make certain comments, I think Aditya and I will be happy to consolidate industry comments and put it across to SEBI. So there are a few suggestions coming from SEBI. One is that if the AIF is buying or selling securities from an associate or from any other AIF where the manager is the same, or an associate is a manager or a sponsor, then you need consent from 75% of the investors for such purchase and sale. Second is a relaxation. Today, as you know, the KPI for the KMPs is a 5-year track record. SEBI proposes to do away with that and replace it with some kind of an examination similar to the NISM, where you could obtain a certification from one of the institutions notified by SEBI. So even a fresh manager who doesn't have any prior experience can now set up an AIF after passing this exam. The third is on the dematerialization of units. I think this will have certain implications for AIFs. To start with, it will apply to an AIF which has a corpus of more than 500 crores. They have to dematerialize the units by April 1, 2024. Next is, I think, again a relaxation, particularly for CAT 2 AIFs, which could not liquidate their investments due to bad market situation or whatever. And we have seen cases where they had to either exit at a much lower price, or they had to surrender the investments to the investors itself. SEBI now proposes to allow such AIFs with the consent of 75% investors to transfer those unliquidated investments to a new scheme, And if you don't get the consent of 75% investors, then you have to liquidate the investments within a year. The last one is also an investor protection measure. And sometimes, as SEBI has noted, that an investor may be charged an advisory fee by an intermediary. And then when the investor invests into an AIF suggested by the intermediary, again there might be a distribution fee charged by the intermediary to the AIF, resulting in a double leakage, because ultimately the distribution fee is indirectly borne by the investor. So SEBI has now proposes to clarify that if an investor comes in through an intermediary, then the AIF needs to offer a direct plan to the investor, which means there cannot be any further distribution fees charged to such investors. And even for other cases where investors don't come through an intermediary, distributors cannot charge an upfront fee, and it has to be a trail-based commission similar to what PMS or mutual funds charge. Budget updates, I'm sure you all have heard a lot, but just a couple of things to note from an AIF perspective. One is that MLDs will now be subject to tax as against the current rate of 10% to 30 to 40%. We are speaking to a few clients to explore if there are any ways to get back the 10% rate through structuring in different ways. But I think if it doesn't happen, then maybe it will potentially result in killing of the MLD market, because the 10% effective tax rate was a big reason why MLDs were very popular. GIFT City, I think you'll have heard from Sandeep Shah in the morning, so I'll not talk about that. Another important change is that now if you get foreign investment, you also have to consider the tax valuation, which so far applied only to resident investors. So I'll explain that with a very simple example. If the par value of a company is, let's say, 100, the fair value is 150, FEMA allows the company to issue shares to a non-resident at any price above 150. Let's say the company issues shares at 170. Now the difference of 20, which is 170 minus 150, will be subject to tax in the hands of the Indian company as other income under section 56 to 10. So it creates a very difficult situation where one has to walk a tightrope, where I cannot issue shares below 150 under FEMA, and I can't issue shares above 150 because of the tax law change. So that is on the budget changes. And finally, to close with, I'll take 1 or 2 minutes more in terms of what we do. So this will give you an entire spectrum of what we do, right from designing the structure, considering your structure framework, the tax benefits which you need, the different perspectives in terms of sponsor, manager, employees, etc. Structuring the offshore investments, as I said earlier, the board composition, the carry structure, and then advising on various documentation, preparing the documentation, taking into consideration regulatory and tax perspective, filing with SEBI, obtaining approval from SEBI, and then lastly helping in terms of the various compliances. So AIFs in domestic and also particularly in GIFT City have to undertake a lot of compliances, right from PAN, TAN, FATCA, CRS registration, income tax, TDS, advance tax, filing of 64D, GST returns, SEBI, IFSCA reporting, SEZ reportings to IFSCA, and then FATCA, CRS, RBI reporting, tax accrual, which many AIFs ask us to do in terms of from their NAV perspective, particularly for open-ended funds, return filing, and then Cat 3 AIFs don't have a requirement of 64C, 64D. There we issue statements on behalf of the AIF to investors, and finally filing return and assisting AIF in terms of representation. So that is, I think that completes my part of the discussion. If there are any questions, happy to take it up later.
And the time for wonderful session. Thank you so much. It was a wonderful and a lovely presentation.